Hey, what's going on, guys? Today I want to talk about KURV ETFs, and let's look at a couple of the funds that they offer and kind of how they compare to some of the other popular high income funds out there today. So this is the website. Definitely go check them out. Their whole idea is that many technology stocks do not distribute dividends. KURV Yield Premium Strategy ETFs do. So they are leveraging these six tech stocks. Some of them do pay dividends, such as Google, Apple, and Microsoft. But you can see here the yield is significantly below, like, for example, the S&P 500. Very small yields here. But their whole idea is that they're going to give you access to these tech stocks, but they're also going to be able to create some income from it. So let's go ahead and look at some of the data points here in this table. The popular stocks, these are very popular investments as it is, right? They're almost all FANG stocks. Don't see NVIDIA in here, but Amazon, Apple, Google, Microsoft, Netflix, Tesla. And one thing you'll notice as well is that their distribution rates are much lower. So these are funds that aren't going to distribute as high. They're not as aggressive. So they are a little bit more strategic with, selling their positions. They're selling a little bit more out of the money. So you will see more of a price appreciation, and hopefully the NAV appreciates more than some of the other alternative funds in this space. So I wasn't aware of this link, but let's see what this is. Okay, cool. So it does have you calculate in some of the total return. So looks like Amazon is up 18% year to date. Their market price is 18.44. Apple is up 13.7 or 13.87 if you're looking at the market price. Google up 15.78%. Microsoft up 10.93% or 10.78% at the NAV. Netflix or NFLP up 29.79%, 29.88% on the market price. And Tesla up 3.71% or 4% on the market price. So, obviously these are not as great performers as the underlying itself. However, I think this one might actually be outperforming Tesla. We'll look at, I made a little spreadsheet here, but keep in mind some of these numbers, and we'll see how they kind of compare in a little bit. The whole idea with their strategy is to seek and generate monthly distributions by collecting option premiums through selling call options on a stock. As a result, they can help cushion the volatility of the underlying stock. Obviously, bear market, it could act as part of a downside hedge. However, do keep in mind whenever you sell covered calls, you are selling the upside. So what's different about them? They strike a balance between income generation and potential upside capture in rising equity markets. So that's why their distribution yield is a little bit smaller there. Designed to effectively gain stock exposure, leaving enough cash to generate additional distribution from interest payment. Cool. May have certain tax advantages, as not all distributions may be immediately taxed. Therefore, they have the potential to receive favorable long capital gain tax treatment. So here are some of the fund managers. I know Howard. I watched him on an interview on someone else's channel. So do with that as you will. Some different fund brokerages that allow their funds. Pretty much all the popular ones: Schwab, Webull, Fidelity, E-Trade, Robinhood. Okay, so it looks like that's it for this main income page or main page here. Let's go look at the spreadsheet that I made. Yeah, so I'm not sure how they were calculating this total return. It's probably if you also were to drip your dividends. That's one calculation that I did not calculate yet. I was still trying to figure out the best way to do that. So what this is, I'll zoom in a little bit so you guys can see a little bit better. So these are, the 6 tickers that I mentioned earlier. These were the prices as of January 2nd, which I think some of these funds actually didn't start till a little bit later. But so this is the starting price from then, the current price return. So from a price return perspective, Netflix looks like it's the biggest gainer, up 26% year to date. Amazon is the second at 10%, AAPY at 9%, Google 6%, Microsoft 2%, and then Tesla is the lagger there. Their distributions year to date. Let me go ahead and freeze this column. So distributions year to date, here's that column. I pretty much added up the dividends. And then the estimated distribution yield, obviously this changes every single month, but this is kind of based upon their most recent distribution, kind of an estimate. If they were to continually pay that same amount, which as you can see with these funds, they do not do that. Yeah, they're very inconsistent amounts there. But yeah, as far as the highest yielding one, it looks like Netflix is the highest yielding one, coming in at 20.7%, followed by Tesla, then Amazon, then Google, then Apple. I might have missed Microsoft within there as well, but yeah, so that's some of the calculations there. And then adding the distributions plus the price return. Apologize, I misspelled there. In case anybody's OCD out there watching that. So the total return, calculating both of those, looks like Netflix has been the winner for that as well. And then price returns plus distributions at 40%. So yeah, like the website, like I was talking about a little bit earlier, showed some better numbers for some of these, and that's probably because they were accounting for the drip, which this calculation is not. So needless to say, though, these funds are performing better as far as, the NAV erosion or NAV appreciation in this case, plus the distribution. So if you're looking for a asset class similar to some of these other high yielding income funds, but you want more of an upside potential, just keep in mind that you're going to get a smaller distribution yield, which if you're fine with that, KURV ETFs could be some investment that you could look into. Definitely do your own research, not financial advice here. I just kind of wanted to, as I was just recently recommended, someone had mentioned TSLP. So I went and did some research, and then I came across their funds. It was kind of pretty interested how they differ a little bit there as far as, smaller yielding. So you don't have to worry about the NAV erosion as much because they are, selling a little bit further out of the money than some of these other funds there. So yeah, needless to say, though, it does appear that NFLP is their biggest winner, year to date. Let's see. See if I can switch over my screen share here. Okay, there we go. Going back to their website. So they do also have another fund. I'm not going to really go into depth with this one here. A ticker KQQQ. It is their Technology Titan Select. So it's a little bit different there. I don't think the yield is as high. It's more of a tactical growth play. I'll make another video on that. But I wanted to see kind of how let's see. Let's go back to the all ETFs. Let's go back to the homepage. And I kind of wanted to see how the spreadsheet numbers compare to the actual what's listed on their site. So I think it was yield premium. Here we go. So we wanted, okay, so this is the quarterly return. So Amazon, my calculation was up 20% year to date, whereas theirs was 18.23%. Okay. So ours is a little bit higher there. Apple at 13.7, ours is at 17. Google 15.63, ours is at 16, so that's pretty close there. Microsoft up 10.78, and ours came in at 11, so pretty close there as well. Netflix coming in at 30%, ours coming in at 40%. So what is the differentiate with that one? Okay. Let's look over here. Okay, so that's solely from, so these must just be price returns. That could be, I don't know. I don't know how they're calculating these numbers because it's not adding up to me for some of these here. So like Netflix has a price return dating back to January 2nd of this year as a 26% price return, whereas their website is showing a 29% return. So yeah, not really sure how to calculate these numbers here. I apologize, guys. It's just seeing some, I don't know if it's just a different bid-ask spread that Google Finance uses, but just some inconsistent data there. And then lastly, I guess Tesla, we had Tesla as a negative 25% price return and a total distribution, total return of negative 12%, whereas the website here has them at a positive, NAV plus market price of 4%. So yeah, I'll have to do some more research. So the dollar value of a single share based upon the value of the underlying assets of the fund minus its liabilities divided by the number of shares outstanding. Okay, so that's the NAV. The current price, which are spot and sold. Okay, yeah, so I'll have to do some more research here either way to see kind of how they're calculating these numbers here. Oh, okay, so it says as of June 30th. Duh. Okay. I apologize, guys. I was not even paying attention to that date. But that makes total sense now. The dates aren't the same. Okay, so good to note there. Okay, we'll jump back in the spreadsheet because that's more up-to-date data. I was like losing my mind. I was like, why is this data not adding up? But yeah, okay, so I feel a little bit more confident now with my calculations here. Still Netflix has been on a tear this year. Obviously, the underlying has been doing pretty well. But NFLP coming in with a distribution yield of around 20%. Total return 40% without the drip. So if you would have dripped it as well, obviously you would have got more shares, which you would have made more money on the distribution and stuff like that. So stay tuned for that. I'll try to figure out to see if there's an easy way to kind of illustrate drip on some of these funds. I think it would be valuable to kind of get an assessment. If you were to just turn drip on, what kind of returns you could look at as well. So yeah, guys, that's going to be it for today's video. I know it's a little bit longer than normal. Kind of wanted to kind of look at some of these funds here and just kind of evaluate from a high level speaking. Obviously, we didn't look at the assets within these funds, but to my understanding, it's going to be a mixture of, purchasing the underlying and selling covered calls, and then also, using synthetic positions as well to kind of mimic a position and the ability to kind of leverage that. So, very popular in the industry, creating synthetic calls and so on. So, yeah, guys, that's going to be it for today's video. Hope you got some value from it. Sorry if we rambled on a little bit there with some of the calculations and that data. We'll try to get it cleaned up next time. But needless to say, let me know what you think down below. KURV ETFs. Is it something that you're interested in? Is the yield too low? Do you care about more of a distribution yield versus your overall total return? Let me know what you think down below. Please like and subscribe. Helps us out a lot. And stay tuned for next time. Thanks.